Welcome to CRISIL TV. At the peak of the global financial crisis, the world economy had sunk to minus 0.5%, the worst performance since the Second World War. After that, a lot of stimulus was pumped in, both monetary and fiscal, but the recovery has been very uneven, very fragile, and people have very low confidence in sustainability of the growth path. And also what we saw during this period was the central banks became more aggressive with monetary policy and went beyond the zero bound. We've seen quantitative easing, we've seen negative interest rates, and we've also seen now helicopter money being discussed. To discuss all this and more, we are privileged to have Dr. Paul Sheard, S&P Global's chief economist, with us. Paul, we often hear that the world economy is leaning too much on the monetary policy to support growth. And I think they've already entered uncharted waters. We hear all sorts of instruments being applied. Quantitative easing and negative interest rates are already there, and now there's talk of helicopter money. Why is it that you need so many instruments of unconventional monetary warfare, if I may say? And is the stock of ammunition unlimited in the, as you say, in the monetary Garden of Eden, or is there a forbidden fruit which I think the central bankers should be watching out for?
Well, DK, certainly central banks have come in for a lot of criticism for many of the unconventional, innovative actions that they've taken. And I think the big message there, really, that historians will probably take from this period is that there was an over-reliance on monetary policy. Prior to the crisis, monetary policy was kind of the king of macroeconomic policy stabilization. Fiscal policy was something that was not really favored. But this was a period, or has been a period, where monetary policy, because of those deleveraging forces, has not been very effective. That means that monetary policymakers, central bankers, have had to dig very, very deep. So I think the balance between monetary policy and fiscal policy has been a little bit out of whack. There could have been, and probably should have been, more active and sustained reliance on fiscal policy to make sure that the two cylinders were firing. But you can't really blame the central banks for that. They have to really do whatever they can within their mandates to achieve their objectives. So I think much of the criticism that is directed at monetary policymakers for going too far with their monetary policy tools is really misdirected. The criticism should be more at the government policymakers for not using the policy tools that they have. In terms of, you mentioned helicopter money, that is something that is not really being implemented yet, although some people would argue that QE and budget deficits together is a kind of helicopter money. But the idea of helicopter money really is this idea that Milton Friedman had many, many years ago in the 60s of, well, why not just give cash directly to the public? And particularly if that cash is kind of a gift from heaven, from the helicopter, they should want to spend some of that money, and that should stimulate the economy. And it's sort of money. The key with helicopter money is the idea that it's money that you don't have to pay back. It's new money creation. It's pretty controversial, though, because it does blur the lines between monetary policy and fiscal policy, and that sort of tends to be sacrosanct. And also, to the extent that it's the central bank that might be driving or flying the helicopter, it does call into question, is that something that the central bank should really be doing? So it's still something I think that's very much in the realm of the hypothetical and the controversial at the moment. But I think the point is that if the global economy does go into another downturn, that's not our forecast at the moment, but if that were to happen before policymakers were able to rebuild their stock of ammunition, maybe the next unconventional tool is going to be something like helicopter money.
And I think now let's come back to India. I think you've been traveling in India and also talking to various stakeholders. What are the impressions you gather from this visit particularly?
Well, I'm fairly positive on India. Looking at India from afar, I think India has a lot of things going for it. Obviously, it still has a lot of development potential left, a long way to go, a good development runway. The demographics are on India's side. There's also a lot of reform momentum here, and also a track record now. Particularly post the financial crisis. Let's not forget that India has performed very, very well in probably the most challenging global economic environment since the Great Depression. It's been a little bit in the shadow of China, but now it's emerging from that shadow. In fact, growth we expect to be on a sustained basis higher in India than in China. But I think my takeaway from this visit is really some of the interesting things that are going on around the reform process in India, and the acronym that I've picked up that I'll be taking home is JAM. The fact that you have these new initiatives around really connecting with technology, the government to the people. And that's a very exciting agenda, and we'll have to wait and see how far that runs. But there's certainly some things happening in India which probably the rest of the world has not really fully picked up on yet. So I think that's good news as well. As international investors perhaps get a sense of what's going on here, I think there's scope for some positive reaction to that.
Thank you very much, Paul, for your insights. And thank you very much for watching CRISIL TV.